Welcome to the Trader Merlin Show with your host, Merlin Rothfeld.
Hello, everybody. Welcome to Trader Merlin. In response to President Trump's comments about the economy and the state of emergency with regards to the coronavirus, we take broadcasting very seriously here in the show today. So I am greeted in studio with a very safe and protected Larry Jacobson. Larry, how you doing?
Good, Merlin. Let's do ready? Elbow bump.
Elbow bump. Let me get some Purell here real quick. I want to make sure okay, good. We want to make sure that we're safe when we send out our messages through the airwaves. Hope everyone is doing well out there today. So just because of this, I'm probably going to actually contract coronavirus, and all next week I'll be broadcasting from my home all alone. Let's hope I didn't poke the bear with that one. Happy Friday to everybody out there. No, we won't keep these masks on the entire time, but probably for the first few minutes.
Yeah.
For those of you who are paying attention to these markets today, holy shnikes, what some crazy volatility is going on. I actually heard from a friend of mine saying that Bloomberg was saying, or was it Bloomberg? Let me get my sources correct here on today's show, saying that it won't identify my face with a face mask on. Gotta love iTunes. Bloomberg said, don't expect investors to expect that 10% moves every day.
Yeah.
Yes, kind of crazy. We saw, let's call it 10% moves up today, down yesterday. Lots of crazy action. Are you enjoying these markets, Larry?
Yeah, I mean, look, if you know how to trade it properly, it can be very, very lucrative. And what we're excited about today is because a lot of people have been contacting us saying, well, okay, what if this is a true crash? How do we take advantage of it? And so many people wanted to know, like, what should I have known back in 2009 when it got to the bottom? So we decided to do a show on that today.
You know, it's interesting because last week we did one which was really saying, how do you profit from the coronavirus, which was specific to that, the impacts from that specific sector or how the virus would impact certain market segments. Today's is different. Today's is something I think is going to be more broader and allow anybody who's looking at this from the point of, when do I buy? Which, of course, you guys saw me tweet out last night. I am getting blown up on my phone, my Instagram, my Facebook. People going, when do I buy back in? I want to buy back in. Is this the bottom? It's like, relax a little bit, and let's think about what is going on here. So let's start off with our discussion of 3 ways to profit from a market crash. Larry does a lot with strategic investor and proactive investing, long-term perspectives. He's a disciple of Warren Buffett.
Yep.
So where do we start here? These markets are, for many people, in a free fall. This is pandemonium. Do I buy back in? If I do, what should I look for?
Okay, so what you have to understand first and foremost is, are you going to be doing more active trading or longer term investing? Because if you're actively trading, you're doing everything you should be doing right now, looking for the swings in the market and trading them, and that's a different entry type than doing maybe longer term wealth. Now, what I'm going to show you is something very fascinating, because we used to do this back on the old show, right, Merlin, in terms of picking out different stocks we thought would be great, because one of the things I learned many, many years ago, and I guess if TJ can bring up the chart, I'm going to do a little study here to show everybody.
You're going to go to the Microsoft one?
Yeah, let me do that.
Okay.
I'm going to take the mask off so that I can actually talk through.
Oh my God, I don't feel, more Purell. I need more Purell over here.
So TJ, if you want to go to this chart, I'm going to show you an example here. Let's just look at Microsoft. And I'm going to show you what you have to understand is, and this is something that Warren Buffett said many years ago, it's not that the company is broken, the stock is broken. And so a lot of people don't realize is that we don't have to wait for the market to bottom out to be able to get a good deal. So if we look at this chart right now, and I'll kind of take you through it, in 1975, Microsoft decided to become a company. Now, if you ever saw the picture of them, you'd be kind of scared of them. You've seen that picture, right?
Yep.
They all look like a bunch of hippies from the 70s. But notice that their intrinsic value, that's the blue line, what is the company truly worth, starts to grow when a company starts conducting business. Well, we can see here that at some point this company would have what they call a return on equity. What is its growth since they started the company? Well, 1986, the company decided to go public. And when they went public and the stock was actually offered to the public, they had a market price of 120 million. Now again, market price does not necessarily represent the true value of a company. What the intrinsic value represents is if we were to sell Microsoft off at that time, just every aspect of the company, how much money would the company raise, and then we would say how many outstanding shares are in their float, and that would what the true value or intrinsic value of the company would be.
Crazy to think, $120 million market cap for Microsoft. That's just nuts.
Right, and that's what happens. So watch what happens from here. You're going to see two different things spike. The blue line is the continued intrinsic value growth. This is what the company's really worth. The green line shows you how the price of the stock was trading around that company's true intrinsic value. So when we started to go above that blue line, we can say that the company now is overvalued compared to what it should be selling at. And if you take a look here, in the year 2000, in the height of the tech bubble, the company was worth $600 billion on paper because the stock was worth $59 a share. But take a look at this. At the same time, the company was truly only worth $200 billion in its true valuation. So there was a $300 billion swing that, for all intents and purposes, was really just kind of fluff.
400.
Oh yeah, 400, thank you, 400. Now watch what happens from here. Price starts to come down, and we start to see this cross. Well, right there when this cross happens, we now have the first glimpse that maybe we can get this stock at a discount. And so watch, for a long period of time after the year 2000, there was great opportunity to be able to buy Microsoft stock cheaper than what it was truly being worth. And look down here at 2009, this company was worth less than basically what it was in the height of the 2000 bubble. So you could have bought the company stock at $106 billion of market price, but the company, it was worth $313 billion. So this is where Buffett was talking about the company isn't broken, the stock is. Notice that since they went public in 1986, the blue line, the valuation of the true intrinsic value of the company, has kept going up. It's been the stock price that's been fluctuating. But in 2009, everybody was so spooked, nobody was going in there buying it at $15 a share. Why? They were still licking their wounds, losing money at $60 a share. And as you can see, this continues to happen, that there's opportunity to buy it on the cheap. And then eventually in 2017, the price of the stock, go back one more. Yep, got very, very expensive
now. So
yeah,
real quick, just as a repeat, because we got Capman asking that true valuation. How does that determine? What sort of things go into that calculation?
A whole bunch of things. It's too much for this one show, but that's the thing that basically I spent a long time learning, was how to do value investing valuations. And so when we were going on the show, it comes into different factors of you having to project out what this company can worth. But here's the key: you can't do this on a company that's been around less than 5 years. They don't have any track records. So that's why Warren Buffett wouldn't have bought at Amazon when it first came out. He has to look at the past. So what you're doing with value investing is you're looking at the past and how the company has been able to grow with a projection on, do you think this company will be relevant 5 to 10 years into the future? If you do, then you come up with a valuation, and then the goal is, can I buy it cheaper than what it would truly be worth today? So there's the sticker price, the blue line of what it's worth. Can I get it at a discount?
Right. And, this would be the same thing as someone who's flipping houses, right? If you know that the market in this area for homes, the average home is, let's say, selling for $500,000, and you find an old fixer-upper that's selling for $350,000, all right, it's already $150 below market. But it's junker. But maybe I put in $50,000 and now it's back up to market. I could make $100,000. That's essentially what value investing is saying.
Absolutely.
But again, there are different requirements compared to real estate versus the equity markets. And I think it's important to understand that when Larry's talking about value investing, it's not just, hey, the share price is cheap. Because we are probably going to see an era real soon where you're looking, wow, these prices are really cheap. It still may be overvalued. Even though the stock price has gone from 80 down to 20, it still may be overvalued. There's fundamental numbers that you need to look at.
Absolutely. And that's one of my points of bringing this up, is to make everybody aware right now, don't just buy something for the sake of buying it. It may be down at that price because that's where it should be trading right now, and the markets have just kind of reset. What we're looking for are companies like you can see here in 2009 with the Microsoft example. How great would it have been to have been buying this stock for a third of the valuation of what it really was worth? And so imagine buying it at $15 and then it gets back up to the blue line and you're back at parity. And then you have to think about, is there a future valuation? There's a lot going into this, but the reason we wanted to bring this up is you're going to get the temptation to want to jump into all these stocks that you think might be great stocks. So those are great for active income trades. If you want to trade price, absolutely, because you have supply and demand. But if you're looking for a longer term wealth investment, there's going to be great things like we saw back in 2009. And there were companies that if you bought those, Goldman Sachs of the world, you could have made a ton of money now coming up over these last 10 years that would have been worth it versus buying a dog and then it either goes sideways or basically completely drops.
Great comment here from Trent. He says, my family thinks buy and hold is the only strategy. I warned them to sell and they didn't. Now they're like, tell me more about the strategic investing stuff. Yeah, everybody wants to know about it when they don't want to know about it up front, but when it's finally in their face and they're panicking, now they want to know. That's one of the beauties of what we're doing at Online Trading Academy, is educating people to be prepared. The important part for me anyway, in the first step of 3 ways to capitalize on a crashing market, was the fundamental side. And of course, you have to look at those fundamentals and say, is it right for me? Everyone might have different circumstances and time horizons. Now, for Larry, I'm sure Larry right now is probably doing one of these on a regular basis because a lot of these stocks are down 50%.
Yeah.
You look at the cruise lines, you look at airlines. I mean, some of these things are absolutely slaughtered, and fundamentally, they're probably still very sound companies. Granted, we'll have to wait until Q1 earnings, and I have to make a major correction here. I've been saying Q2 earnings. That's not what I meant. Q1 would be April's earnings, so the first quarter's earnings. So wait for the results of Q1, I think, personally, before you start jumping in. But there are going to be some great opportunities, and there might be some right now.
Yeah, and don't presume, like you said, an airline might go down. Warren Buffett got burnt in the 80s trading airlines, so it has to be at the right valuation. It has to have the right outlook, because value investing is different than even strategic investing, where we're just looking for opportunities to get in lower to drive price up. Here, what you're doing is you're looking for great companies that you'd want to own, great fundamentals, and it has the ability to be bought at a substantial discount. I mean, Buffett will look anywhere from 25 to 50% lower than what the blue line would tell him.
Correct.
And that's where he's looking to jump in. Yeah, and that's how he's made his money over the years.
Capman says we need an hour at the pros or XLT on how valuation is done. Do you do that?
No, because I spent a lot of time building this. And so
maybe down the road.
Maybe, but
I know some of that stuff is incorporated into the strategic investor.
Maybe it's just signature series. I don't know yet, because it's just, this was stuff that I've put 10 years to 15 years of my life into learning. And so there are some things that have to stay proprietary.
There you go. All right, so number one ways to capitalize on this crashing market is obviously going to be fundamentals. Personally, I will say that looking at the fundamentals and all those different valuations, and I'm just speaking for myself here, is a pain in the ass. I don't want to take the time to do it. It's just too much effort. Call me lazy. I don't want to be taking all the time. I'm okay with that. But I think that there are some people that really, really, really enjoy that type of thing, and that's awesome. I think you can find some great deals. My guess is probably in April, May, June, you're going to find some tremendous deals out there. Let's go to number two. You were talking about options.
Yeah, number two with options are, and this can be done in one of two ways. If you want to use it for the value investing model, you can too. Maybe the price to buy 100 shares of stock, too expensive. You can buy leaps. I mean, there's no reason we can't go out anywhere from maybe a year to 2 years right now on some of these companies. Yeah, it'll be a little more expensive because it's a leap with some more time value in it. But how great would it be to be able to control 100 shares, 200, whatever you can afford, of stock at a discount? And remember, if it's moving in the right direction, we're going to see a greater appreciation percentage-wise of the option rate of return because you're buying it through leverage. So there's nothing to say right now that you couldn't do that. As far as you're trading right now, a couple of strategies. You can do deep in the money options if you wanted to do that without including value investing. Options are great. You could also be doing things like what I call ratio back spreads, which gives you an opportunity to put on a trade, and even if when you're wrong, there's a potential of still being right, making money. So there's a lot of great strategies right now designed for these type of markets where we're expecting bullish and bearish moves.
I'll give you guys one example of this and just give you an example of the rate of return that's presented to this trade. Now, I want to be careful here because I know regulators love when people throw out, oh, I made X or I made Y. So we're trying not to do that. But the rate of return on this specific trade, if it works out, would be right around, I believe, about 12.5%. I could probably run a calculator as we do this. But I told you about the trade I made yesterday. I told you I sold some puts on United Airlines. And for that, I was rewarded with $31.50. So it's $3.15 per put. You calculate that out, I made $3,150 on that. Now here's the chart for this. And I want to go back to, this is a weekly, go back to a daily if you wouldn't mind, TJ, and show them, go out, you have to go out a little bit further to see those lows. Boy, I don't even know if we can get to those lows. Do we get to those? There it is. You guys can see that this was as of yesterday when I made this trade, okay? So right as we neared the end of the market yesterday, I sold those puts when, actually it was at 39, so it sold off a little bit more. But right where my horizontal line is, that's where I sold 10 puts on United Airlines for 25, right? That's basically, I'm committing myself to buy United Airlines if it drops to 25. And that's going to be in 1 month, in April. So for 30 days, I'm going to get paid $3,150 for the commitment to buy United Airlines at 25 bucks. Now, many people probably think United Airlines is going to drop and get to 25. That's great. I'm okay with that because in my longer term portfolio, I'm okay holding United Airlines. I think that they're going to bounce back pretty strong. But if it does get down there, what happens? I'm not really going to be paying $25 for that security. Remember, I'm going to be collecting $31.50, so it's actually going to be $21.85 per share is what I would be my average price on United Airlines. I'm okay with that long term. If price stays right where it's at, or United Airlines bounces from here, I still get to keep $31.50. But remember, my initial investment that I'd be committing to would have been $25,000. That's right around a 12% rate of return for 1 month. And in this market, we have a lot of time or a lot of opportunities when you have very high premiums. And right now, it is good to be a seller of those premiums in this market.
Absolutely, and that's where you have to be careful too. You don't want to go too far out of the money, because if it doesn't move in the direction that you did, you've got a lot of time value in that option. So that's one of the reasons we talk about this in detail in the options classes that we teach here, is to help you understand the risk reward and what's impacted by the decisions that you make.
Yep. I mean, just to make sure everybody hears this one, Big Ed says, Merlin, you mentioned a market bottom when Q2 earnings. Yeah, that's a misstatement. I meant end of Q1. I'm really thinking April. April, May, and June, I think, are the times where you're going to see some great buying opportunities. When we see the impacts of United Airlines grounding off most of their flights, and same thing with Carnival Cruise, there will be some tremendous opportunity out there. But yeah, I don't know why I said Q2. It's Q1 that I'm looking for, so just make that correction there. All right, so options, and this is, we talk a lot about this in the program. Options are probably the most versatile tool out there that you can be using. The way I'm using it for that trade I was showing was basically saying, look, one of two ways. Number one, I'm looking to buy value. I want to buy it when it gets much cheaper. I'm okay because people are panicking. The other one is, if it doesn't get there, great. I'm still going to be collecting a rate of return on that money, which is obviously going to increase my rate of return for the year. So those are my ways of using the options.
Yep, absolutely. And again, if you don't necessarily want to hold it, there's a way you can do types of spreads that actually create credit as well. And as long as you're basically within this range, there's a good chance, even if it doesn't work out the way you want, you still have an opportunity to do those with the ratio back spread. So I happen to like using those a lot.
Ratio back spreads. All right, last one. And this is for me is always a debatable topic, but so many people go, I love dividends, and you think dividends are a great way to capitalize on a market crash.
Well, it depends on the play, and how I came across this, it was really kind of by accident. I wasn't at Online Trading Academy, full disclosure back then, but it was around 2000, 2001, 2002, and if you remember, the tobacco industry was starting to get sued. And it was pretty interesting because the states jumped on board and were going against the tobacco for secondhand smoke, and overnight it was kind of like Philip Morris stock. So MO,
change your name.
Yep.
Protect the innocent. Or Altria. It's
right.
still Philip
So if we
Morris.
go back to 2000-ish, you'll
2000-ish?
see. 2000.
TJ's going to have to.
Yeah, it'll be about 2000. Yeah, I got to keep going back a little bit further.
There you go.
So right around that area, there was a big
right
sell-off.
where the cursor is, there's 2000.
Yep. Let's see. It was no. It's
this is January 2000.
Yeah. So notice it went from about, and this is kind of interesting, all the way up. Now this might be PM right now. That's going to be
so it went 14 to 4.
Right. But again, at the time, it might still be under Philip Morris PM. I don't know. I haven't looked at the chart. But here's the story. So when the lawsuits came out, the stock pretty much went from around, for what I remember, 60 to 80 down to 20. Mm-hmm. And my buddy called me up and he said, well, what do you think about Philip Morris? And I went to look at their quarterly statements, because they still have to file quarterly. They made billions of dollars in profit, even though the lawsuits were pending. But here was the thing that I noticed, Merlin. Mm-hmm. The dividend yield shot up. And all of a sudden, if you remember, it was right after the tech bubble. Mm-hmm. You couldn't buy anything that was going to give you any type of return at that point. Nobody was touching the stocks. Well, here was Philip Morris right now that gave you the opportunity to buy it at a discount, and you were getting somewhere between 6 to 8% in dividends. Mm-hmm. So that's where there's this opportunity that if there's a stock that you like right now and it fits that model, you might get a better rate of return in the current time trading the dividends and having a guaranteed amount coming in the door than necessarily trading price that we think it's going to keep going down, down, and down. Because unless the company is willing to go bankrupt, the only way they're going to keep their shareholders happy is by paying them dividends.
But they could cut that dividend.
They could, but if it's a good company again, they're not going to. They know they're going to kind of weather that out. So this again comes down to, is this a company that can sustain and have enough runway to get through the virus, which hopefully won't last too much longer, and then re-gear up again, or is this a company that's really on the brink? Where if they do now have this problem going on, this is just the tipping point that took them over the edge. Mm-hmm. They were hanging on a string to begin with.
So on that note, let's look at a couple examples, because right now I think you're looking at markets that may present some very attractive dividend plays. And you look at the valuations. I'll start with one that you just mentioned. Here's Philip Morris. And if you look going back into 2017, this is still on a monthly chart. They were up around, let's call it close to 80, and now they're at 40. So you have a security that's dropped 50% in value. We could go back through, look at the fundamentals, and figure, maybe even qualifies for Larry as one of the fundamental adds to a portfolio. But it's also paying a 9.23% dividend.
That's my point. So imagine buying it here, you're locking in the dividend rate, and then all of a sudden the price goes up. Now you've got the benefit, because we don't know. I mean, we have no idea what's out there right now, because these things start off, I've talked about it. I think we even talked about it on the show months ago. It started with that August 15th inverted yield curve, and we were all talking, and you and I were saying, well, maybe in about anywhere from 6 months to a year, we could wind up seeing a recession. Now there's a talk of recession, and then usually it's followed by a crash. That's historically what's happened. So this might be leading into something bigger. And just because we had this bump today, how do we know this isn't resetting right now into basically a much more dramatic drop once we get up to where the sellers were?
Yeah. All right, so you got 9% on that one. Let's look at a couple others.
Yeah.
There's a few here, one in particular that I'm kind of interested in, and I like cruises, but I'll save that one for the end. Drug companies. You guys know that in my portfolio, I'm not allowed to own drug companies, but you have Pfizer. So Pfizer, I think many would agree, is probably a pretty darn good company out there, probably not going away anytime soon. Don't they make Viagra? I think they're going to be around a while.
Why do you pretend you don't know anything about that?
So you got $45 just in November 2018, hit a low this month of $30. So not a huge drop off, but certainly a value decline. It's got a 5% yield. I'll look at a couple others here just so you guys get an idea. I'm really picking the stable ones too. If you've got some no-name company that's giving you like a 20% yield, be careful with that. Here's one that's interesting, and I personally wouldn't be buying Ford.
No.
Wouldn't do it.
That's not one on the list.
But you have, their share price was $18. It's now trading as of close today right around $5.75. They're offering an 11.2% yield. I mean, at what point do you go, 11.2% is worth it?
Well, you got to ask yourself, if you believe that this stock has the potential to recover, then you're doing a dividend play. So right now, as long as this stock doesn't continue to keep dropping, it might go kind of sideways for a while. That can be more ideal as this thing kind of work its way out. With the virus right now, you could be locking in the next few quarters an 11% dividend right now, which is pretty much a guarantee of 11% on the money that you invested.
Let's see. GM also has an attractive one, only 6.6%, but I'll just show you guys the GM chart for those of you who might be interested. And by the way, these are not recommendations. I'm just showing you some securities that have had some hard times the last couple of years, maybe even the last couple of months, and may present opportunities. Probably one of the best, I don't know what just happened there. One of the best out there on this list as far as companies and stability is going to be ExxonMobil. That's XO, P1XOM. ExxonMobil. Now, you'll notice ExxonMobil has taken a bath recently, down over 50% just in the past, let's say, 8-10 months. But if you go all the way back to where it was in 2014, you're up at $105 per share. Right now, you're looking at $38.12, and they have a 9.36% yield.
It's pretty, again, if you think that you can basically get that trading it back up, then you might want to invest in the stock, and then you get a little bit of a bump. You get the dividend, and you're also going to get the appreciation.
Yep. All right, last one. Now, we are in a time, and of course, some people are giving me a hard time about my United Airline selling some puts there and potentially being a buyer of airlines. What about cruise ships? What about these? And by the way, I missed the joke the other day. It was so funny. I was on the program going, or I think it was Brandon saying, if you go get cruise lines right now, they got a special. You buy 1 week, you get 2 weeks free. And I was like, oh, I get it. That was a good one.
That is a good one.
Carnival. Okay, now Carnival isn't just cruise ships, but if you look at the 3-month run of Carnival here, I wish TJ could start playing taps in the background, because this is certainly like, this is ugly if you are a cruise ship shareholder. So imagine you got some stock options, like, okay, your exercise price is $60. You're like, yeah, I'm getting shares of the company. Yeah, it's at $17.58 today.
I want to know if the love boat became the hate boat.
There's not much loving going on the boats. I guess you're locked in confinement the whole cruise. All right, enough. We go up to here to the January of 2018. You had Carnival cruise ships running at a high. The highest was $72.70. Here we are today, as of March 1st. Well, actually, March. We'll call it March. What are we at? The 11th today? 12th? 14th?
12th.
Something in there. I don't know.
13th. Friday the 13th?
It's Friday. Oh, the nightmare of having. And we have our Jason suits on tonight. If we only have hockey masks and some machetes, we'd really be killing it. It hit a low of $14.70. So here you have a security, which I don't know if they'll be solvent, but 72 all the way down into the teens, and they pay a very handsome dividend, 13.36%. Is this one that, as somebody who is a Buffettologist, would you look at this and go, Yeah, I might go for that.
Well, again, it's not necessarily being a Buffettologist. When I saw that, it was just, wow, this company's still able to make money and sustain the downturn. And then all of a sudden, the goal was you at least can lock it in. So it's what's going on in the markets too right now. You know, there are a lot of people going, okay, I don't want to really jump into something, but if I'm going to jump into something, why shouldn't it be something that can generate at least some income for me while I'm waiting this out?
Yeah, we'll see. You know, the interesting thing about that Carnival Cruise Line chart is we have, actually, you did come into an area of demand, but I don't know if I would put much emphasis on that, to the 2009 low. You have erased a 11-year run in Carnival Cruise, actually a 10-year run in less than 2 years. Amazing.
Yeah, it's pretty scary.
All right, so those are some of the factors out there. The topic for today was 3 ways to capitalize on a market crash. Of course, that's going to be from the long-term fundamental perspective or long-term perspective. At some point, you know, we will probably talk a lot more about, you know, now might be a good time to buy into these markets. And we'll probably be doing a little bit more analysis. My guess is that will probably be at the end of or during Q1 earnings reports, which will be starting April. It's mid-April. I believe Alcoa is April 14th or 16th or something like that. And they're normally the kickoff for earnings season. So we'll have a clearer picture of how they're really getting hit with this coronavirus situation and what it means for everybody out there. So fundamentals, as I mentioned earlier, I am just way too lazy to sit down and find out what the intrinsic value of it might be. So I probably would shy away from that personally. Some of you might love it. Larry loves that type of stuff.
I think it's just awesome. If it's an opportunity to get back into a stock you might have wanted to be in, it's just too expensive for you, and there's a reason to be back in.
Number 2 was options. This is something that I am doing. I'm looking out there right now saying, are there price points where I would be okay owning some of these? I mean, you could be selling puts right now on Carnival at, let's say, $10 or $5 or something out there. And, you know, is it worth owning Carnival at $10? Maybe. That's if they can stay solvent. Who knows? They might end up going bankrupt on this whole thing. But
as long as the ship doesn't sink.
But yeah, I know we had Big Ed saying this thing's going down faster than the Titanic. I usually like to say it's going down faster than Britney Spears' career, but she managed to make a comeback. It's amazing. Let's see. Let's go to. There was a comment came in here earlier about Macy's. Where'd that one go? You got a whole bunch. So Brendan says, hey Merlin, quick question about Larry, what do you think about Macy's? Their dividend is nuts and the valuation is very cheap. The specific dividend for Macy's right now, they're paying about 20.46% dividend yield.
Yeah, right now, I mean, I have to do analysis on it. It can't just kind of off the top of my head take a look at that and see all the different factors.
But the chart doesn't make me feel any
better.
No,
I mean, you're in a really strong downtrend right now.
We're actually right at the 2009 lows.
Yep.
I wouldn't put much emphasis on this. And, you know, this is where we have to take a step back from the way we used to do things, the way we used to shop, the way we used to value fashion and apparel. Macy's is a mall-based company. I can get every single thing that Macy's sells, I would say 100% of their inventory, I can find on Amazon cheaper.
Yeah, I mean, there's definitely more opportunities.
And nowadays, who the hell wants to go to a mall? I mean, I got to wear my face mask to walk around in the malls.
Yeah, I think we should put that back on. We're about to end the show, too.
Right?
We're going to have to deal with the world. Yeah.
So, yeah, we got our mask back on. I mean, this is how you have to go shop at a mall nowadays. I got to walk out there and be like, yeah, can I go to C's Candy and buy myself some chocolates? Don't touch it with those hands. I need you to put gloves on. I don't know.
So M&M's going to do now, it melts in your glove, not in your mouth?
I like it. You coming up with some new slogans here. Yeah. Slogans for 2020 that must be met for our markets. Anyway, so we went from fundamentals to options to dividends. A lot of stuff out there. And Brendan, you mentioned a couple things here. REITs. Okay, now REITs might actually be another good thing. So how about REITs? They're legally obligated to keep paying dividends. Yes, but has the housing market been slaughtered like the equity markets? And this is the big discrepancy there. You're looking at REITs, which have been looking rather good. And yes, there is a dividend there. But think about what happens. If you go to some of the previews that Online Trading Academy has done, there's a great piece, and they're talking about this trifecta of bubbles. You have an equity market bubble, which I think we would all agree, except for Unscammable, who's no longer on the program with us, unfortunately. I hope you come back, Unscammable. That bubble is popped, or popping as we speak. The bond market bubble is, I'm going to say popping as we speak. And the third one is the real estate market, which hasn't popped yet because they keep crushing the yield down to make money attractive so people buy it. But at a certain point, we will get those three things collapsing. At that point, there might be some tremendous opportunities to buy REITs at a very discounted valuation. But I don't think that would be now. The difference in the charts there, you look at something like Macy's, which is paying 20% dividend. Yeah, their price is down huge. I mean, Macy's in 2015 was trading at $70 a share. It's down at 8 today.
I think next year there's going to have a float. Just the Thanksgiving Day parade. It's just going to be a float.
That's all they do.
It's just going to have their Macy's star. That'll be it.
Yeah. All right, guys, that was your show for today. Of fundamentals, options, dividends. If you'd like to know more about that, there's a lot of different ways you can find out information. Of course, you can go to tradingacademy.com. You can go to otacademy.com to find out more information on the basics of those things as well.
And if you haven't taken Strategic Investor yet, get into that class, because if there's a little bit of a bounce back up, it might be resetting to go back down again. You might get another shot at it to be able to get out a little bit more of a profit.
And if you have family or friends who are telling you, oh, well, just buy and hold, and anybody that tells you right now to buy and hold, just turn to them very politely, as nice as you can, and you say, so how's your 401k doing right now? You're down, well, you had a nice bounce today, but you're still down 20%. Yeah. It could be 30, 40, 50%. So it's not to say that we haven't found a bottom. I don't think we have personally, but we may have. It's about being proactive and understanding that there should be some circuit breakers and limits in your portfolio and ways that we can capitalize on a market correction or a crash, as I believe we are in the midst of. And again, Larry was talking about fundamentals, options, and dividends. Those are the three main ways.
I got a great circuit breaker. My wife takes a rolling pin and says, don't trade if you don't have to.
Wow.
It's pretty cool.
I didn't know that she was an Italian from New York.
Yeah, well,
Forget about it. All right, that's why he has to wear the suit today. All right, guys, that will do it for today's show. Thank you guys so much. Mike says get short and stay short. I agree. Most of the group out here says pretty much be going short. I think that's the direction to stay right now. I'm hoping that we get a nice little rally and then we get some shorting opportunities, as you've heard me say for the last week. We just haven't had that big rally. All right, everybody, that will do it for today's show. Thank you so much for the support this week, and you can really continue to help me out. We've jumped in the podcast rankings significantly. We're now in the top 100 in just 1 week on iTunes. So subscribe to the iTunes podcast. Subscribe to the YouTube channel out there. Click that little thumbs up button if you like the show. Give us some feedback. Until then, happy trading, everybody. We'll see you next week.
You want to go out and get a Corona?
Coronavirus it is. Let's go.
Let's go.
The Trader Merlin Show is produced by Merlin Rothfeld, Gary Christmas, and TJ Writings. The show is engineered and edited by TJ Writings. For more information, visit tradermerlin.com.